again for coming your way today. I appreciate your coming, and also and outflows, which helps organizations achieving their objectives. Accounting is a data collection process dealing with accurate recording, the reporting, the finance is a management or decision process. So we have seen the difference between the two of them. Then we also have the difference between finance and differentiated from economics. Economics is concerned with analyzing the distribution of resources in a society, to study transactions amongst people involving goods and services with or without the exchange of money. It is also interesting in supply and demand, cost and profits, production and also consumption. The broad highlight developed field of economics is closely related to the social science, such as sociology, science, psychology. Economics will be also commonly divided into two. We look at the two of them. We look at microeconomics, which is basic theory to study that business make decisions about pricing and producing in this kind of market, and under the different assumptions also called price theory or theory of fair. And microeconomics tries to explain how rational persons make business decisions, while macroeconomy, which is the study of overall economic situation of a nation or group of nations, it attempts to relate such factors as production and also consumption into a meaningful view of the national economy. So it uses definitions such as gross national product, GNP, to measure the level of economic activities, and has developed fairly sophisticated means for forecasting the future. And we look at the field of finance. Under the field of finance, the academic discipline of finance, of financial management, view in terms of various aspect field. In each field, financial management is dealing with the management of money and also claiming against money. Distinctions arise because different organizations pursue different objectives and do not face the same basic set of problems. Hampton recognized 5 areas of finance. Number 1 is the public finance. Talk about the public finance. Central, state, and local self-government handle a large sum of money which are received from many sources. So we look at tax and non-tax revenue. These funds are utilized on development and non-developmental expenditure in accordance with a detailed policies, also programs, and also procedures. Government have the authority to tax and otherwise raise funds must depend fund according to the legislative and other limitation. Businesses try to make profit, whereas the government attempts to accomplish social objective, economic objectives. Then number 2, we have the securities and investment analysis. That under that, we have the purchases of shares, the ventures, bonds, and other securities involved, analysis and techniques that are specialized. And investor must study the legal investment characteristics of each type of security, measure the degree of risk also involved with each also investment, and also forecast probably performance in the market. So we look at those as the securities and the investment analysis. We also look at the international trade, and these are trade between 2 countries or more countries, and so money crosses international boundaries business, and government must deal with specific kinds of problems each country has, and also its own national currency. So we talk about the policies. We also look at the number 4, institutional finance. The national economic structure contains a number of financial institutions such as banks, insurance. These institutions gather money from individual savers and accumulate sufficient amount for efficient movement. Without this institution, funds would not be readily available to finance business transactions. The purchases or private homes and commercial facilities, the various varieties of other things that require substantial amount of capital. The institutional finance deals with the issue of capital formation and the organization that perform the financing function of the economy. Number 5, look at the financial management. We talk so much about financial management, but individual business face problems dealing with the acquisition of funds to raise, to carry on their activities, and with the determination of optimal method of employing the funds in a competitive marketplace. Business must actively manage their funds to achieve the goals. Many tools and techniques have also been developed to assist financial managers to recommend proper course of action. These tools help the manager determine which source or offer the lowest cost of funds and which activity will provide the greatest return on investment. And also, the manager determine which source of the lowest cost of funds, which activity will provide the greatest return on investment capital. The financial management is the field of greatest concern to the corporate finance officer and will be major thrust of the approach we usually use in study finance. Then we are looking at the scope of financial management. We'll look at the scope of financial management in order to understand the changes role of financial manager and all the evolution of function. It is usually useful to trace the changing role of financial management. In the early parts of this century, corporate finance emerged as a separate field of study, whereas before it was considered primary as part of the economics and account. In a modern enterprise, financial managers occupy the key position and is dynamic member of the top management team. Now he is neither a storekeeper, maintaining the accurate record, raise funds, analyzing the firm from outside point also of view. Then we also look at the traditional approach. The traditional approach of financial management is confined to record keeping, preparation of reports on the company status and performance, and also managing cash so that the firm can meet its obligation in time. And in this role, financial manager are called upon only when the firm runs short of each. Then financial manager was responsible for locating and obtaining funds. It is during the major events, for example, promotion, expansion, merger, acquisition, in the life of the firm, that a financial manager is called upon to raise funds. Then we also look at we move on to the traditional approach did not go unchallenged, even during the period of its dominance. But the criticism related more to its treatment of various topics than the basic definition of financial function. The basic content of the traditional approach, which forms its limitation, may be summarized as follows. Number 1, the emphasis in traditional approach is to raise funds all they need is to raise funds. That's so that they can have enough money. Subject of finance is treated from investors' point of view, so that they can raise funds. Then also the point of also view financial decision making. Two, the traditional approaches are circumscribed to the episode fund financing functions. The financing functions, when we talk about the promotion, expansion, merger, and acquisition. Also, it talks about this, also emphasis on the loan problems and the loan importance of working capital on that. Then we also look at the proper number 4, the proponents of the modern approach besides the traditional approach on conceptual and also analytical ground. According to them, the most significant lapse of the traditional approach is that it neglects its allocation of capital to different assets because of capital also structure. Then number 5, we talk about the traditional approach gives insignificant attention to the financial problem or non-corporate enterprise. The reason for the supremacy of the traditional approach till the early 50s of this century are not difficult to also find out as follows. While during this period, a large number of mergers and consolidation took place, and result was the floating of the large block of types of security, and the pressure of 30s attracts the attentions of the academics as well as the practitioners towards the preventions of liquidity. The fraudulent practice of the form of misappropriation of also misappropriation of form. Then we look at the modern approach, the traditional approach with the emphasis on the episodic financing and lack of sound theoretical underlying out of leave until they change business situation. Since the mid-1950s, the development of a strong corporate sector, technological improvement, widening marketing operation, persistent inflation increased national concern with an endowment. I just want us to look at the aforementioned factors are also required. What steps can be taken to increase the value of the firm, and which new proposal for employee capital should be accepted by the firm? How much working capital will be needed to support the company's operation? Then, where should the firm go to raise more money, and how much will it cost? Then, should the firm declare dividends on share capital? If yes, then how much would they do? Now, all these things are questions that need to be asked by the listed. Then let's look at the functions of management, of financial management. The functions of financial management are also grouped into three financial decisions: the investment decision, the financial decision, and also the dividend decision. And let's look at the investment decision. The investment decision also perhaps are the most important of the three decisions. Capital budgeting, a major aspect of the decision is allocation of capital to investment proposal, which benefits are to be also realized in future. Because the future benefits are not known with a certainty, investment proposal necessarily involves risk, and consequently they should be evaluated in terms of both expected future returns and also increasing risk they added to the firm as a whole. Then these are also factors that affect the firm's valuation in the marketplace, and also besides a decision to commit funds on investment proposal, capital budgeting helps in also deciding the commitment of a future, the commitment of the future, and also the commitment of the future plans of the organization. Then the major aspects of capital budgeting theory relates to the selection of cost proposals rates against the expected return of new investment proposal. Then we also have the additional, there's so many things on it. Then we also look at, let's go to the financial decision. The second major decision of this is the financial decision. Here, the financial manager is concerned with determining the best financial mix or capital structure of his firm. The financial manager must assess the financial requirement for fixed assets, current assets, and also intangible assets. Fixed asset, working capital, also so many of those assets. And also the company can change its valuation simply by viewing its capital structures. So there must be what's called the capital structures when it comes to this. Then we also have the dividend decision. The third part is the dividend decision or the dividend policies. Then under the dividend policy, though, there are organizations that have their own policies of how they give dividends. Then the financial manager must decide how much to pay in the form of dividend, how much to retain or distribute at the profit. Then the dividend payment ratio must be evaluated in the light of the objective of the firm. Its investors in managing not indifferent in the current development dividend. Then we also look at the financial management involvement solution of three decisions of the firm, stating above these three decisions determine the value of the firm to its shareholders. The firm should strive for an optimal combination of the three decisions, maximizing shareholder wealth, because these are interrelated by them. Then we can also see some of the formula there, where we have the things equals the function of I of IFD and into is equals to the for G function of RO, where we have the where V is equals to the value of the firm and investment decision. F is the financial decision. D is the dividend decision. R is equal to the expected returns of share, and also that. And we can also see the diagram below where we are looking at the financial management. Then it goes down to the objective. That objective, the wealth maximization of wealth, maximizing market prices. And we also look at the financial decisions. We have the financial decisions. Then moving on through the financial decision, we have the three decisions policies, where we have the investment decision, where we have the financial decision, and we also have the dividend decision. Then we now look at so one of the things we see the returns. We have the return. What are the returns? Then we also look at the risk. Then both the return and the risk, they now equate to the trade-off. So the trade-off might pay and it might not really pay. So the last part objective of financial management, we have two main objectives of financial management. One of the objectives is the profit maximization to wealth maximization. And when we look at the profit maximization, profit earning is the main aim of every economic activities. According to the approach, all activities which increase profit should be undertaken, and with decreased profit should also be avoided. Then we also look at profits also serve as a protection against risk, which cannot be ensured. Risk cannot be ensured. Thus, profit maximization is considered as the main objective of business. The following arguments are advanced in favor of profit maximization as the objective of business. One, when profit earning is the aim of business, then profit maximization should be the obvious of an objective. Two, profitability is a barometer for measuring efficiency and also economic prosperity of a business. Then three, a business enterprise. Say three, economic and business conditions do not remain same at all times. There's always change as the period comes. You have the recession period, you have the depression period, you also have severe competitions and so many things. So you cannot really predict. Four, profits are the main source of finance for the growth of the business. So the business should aim at profit, at maximization of profit, will enable its growth and also its variable. So profits are the main source of finance for the growth of the business. Said that five also has been criticized as many grounds. They are a firm pursuing of the objectives of profit maximization. Start exploring workers and also consumers. That means the workers, for them to make profit, the workers will be marginalized or made to do more than exploited. That's exploitation. Two, it's also argued that profit maximization should be objective. Financial requirements of the firm depend upon the nature of the business, size of business, and its growth. So if the company is big, then there will be adequate. Then this need help in determining the organizational structure of the department. One, the training skills and the natural ability of person working in financial problem have an important influence on the structure of the financial function. That means the person handling money must have adequate training on how to handle the money. Then some firms make extensive use of computer record handling, witness, or other firms also employ mechanical system in all that. Then we also look at the function of management of a financial manager. We see their function, treasurer, and also controlling functions of these officers. We have so many functions of them, and some of those functions we see here on this platform. We see the administration of funds, and that's giving money out, planning and controlling business operation. They have to plan, they have to control when the plan is being executed. The acquisition of funds, how do we get money to run the organization? Then also accounting, we must always account for the organization. Then also we talk about the protection of assets. The asset must be protected. Then tax administration. Then we also investor relations. They have to relate with investors. Then also we have the consultation. We have to consult with them. Analysis of acquisition, the government reporting, appraisal of economic appeal, then also management of the company's financial organization. Then we will look at number two, the functions of treasurer. Treasurer is responsible for the management of funds and also treasury. Then we look at their function, financial planning. As a treasurer, he does the financial planning, report the financial results to the officers of the company, planning the company's investment program, planning borrowing requirements, also forecasting cash receipts and also disbursement. Also talk about advice on dividend or policy. There is also a cash management, opening accounts and depositing funds in banks. Also management of petty cash and bank balance. Also payment of the company's obligation through proper disbursement procedure, then maintaining record of cash transaction. Then also you start as a credit manager. As a credit manager, you determine determination of customers' credit risk, then orderly handling of a collection. Then we also look at the handling cash, discuss discount and terms of sale for prompt payment. Then 4, we also is the security function, that is recommendation of type of security was desired for the company. Negotiation will also investment bank and also provide for treasury registration of transfer agent accompanied with government regulation, retirement of debentures and preference trade, also shareholders relationship, and also preference development of dividend. Then the last one there is the signing of checks. We also have signing of check. I would be the next this thing is the functions of controller. The function of controller. In this function of controller, we are going to share that maybe possibly on next Saturday when we'll be having this. So we'll talk about the function of the controller. Start as a controller and we'll look at most of the various functions of the controller. So by this time, next week, Saturday, we'll be meeting again to deliberate on some of these things that we have done. Thank you so much for your time and God bless you so much. I still remain Barry George. Yes, and you're welcome to this broadcast. And I know that you have gained one or two things this morning. You gained one or two things this morning. Thank you so much. I appreciate you. God bless you.